Actually, over to you.
Good evening, everyone. This is Sakshi Wadhwani from Emkay Investment Managers. A very, very warm welcome to all of you. I'm very delighted to have each one of you on this webinar. MKH, let me talk a little bit about that. It's our quarterly webinar series where we round up key developments across global and domestic economies, fund flows, market strategy, and a review of our portfolio positions, all in conversation with the fund managers at MK Investment Managers. We have today's fund manager session with Mr. Sachin Shah. He's the fund manager of MK Capital Builder. Looking forward to engaging with all of you in today's session. Let me introduce Sachin sir a bit. Sachin sir has been a seasoned fund manager for over 2.5 decades of experience in the equity markets. By virtue of his extensive research, Sachin sir realized early on the need for a framework in which companies with evasively tricky standing needed to be filtered out very objectively, leading to the development of our equal risk, which is our proprietary model, which helps us to evaluate and compare listed companies on various aspects of governance. Sachin sir also shares his knowledge and insights through various media interactions. A warm welcome to you, sir.
Thank you.
And just to set the agenda for today, we will cover what's been happening in the broader markets and also a little bit and more updates on MK Capital Builder strategy. Over to you, sir.
Thank you, Sakshi. Good evening, everyone. Thank you so much for giving your time on a Friday evening. And I'm sure today's Friday evening is a very, very happy evening. I think RBI has been very helpful to all of us. Uh, yeah, so as Sakshi mentioned, I manage MK Capital Builder, which is our flagship strategy for the last a little more than 12 years now. As you can see in front of you, the chart out there, we have been managing the money quite well. Over this last little more than 12 years, we have grown the money almost 6.6 times, giving a compounded return of nearly 17%. And so basically, what we're trying to say is your 100 has become 660 over this 12 years, right? The good thing is the risk management. This portfolio is really, really well designed to take care of the shocks in the markets. And the best example, as you can see here, in the last 6 to 7 months, we've seen decent amount of correction in the markets. MK Capital Builder, since the peak of 27th September 2024, which is just about 8 months back, is down less than 4.5%, versus most of the indices down in the range of anywhere between 7, 8, 9, 10%. Even if you take the total returns from 1st April 2024 to the 31st of May 2025, over the last 14 months, we've delivered returns upwards of 17%, versus benchmarks delivering returns in the range of 11, 12, 13%. So we have been very, very, I would say, the risk-adjusted returns of this portfolio has been very sound. We will talk a little bit more about this portfolio as we go ahead in the presentation. But before that, I would like to set the context. I would like to also talk about the current environment. And, from that perspective, let's just see the next slide. So if you talk about the global macros, I think a lot of factors are now turning significantly in favor of Indian economy, Indian equity markets, Indian asset classes. So if you see, one of the most important things that I've always seen is in terms of the yield curve. So if you see over the last 2, 3 years, structurally this has been extremely, extremely favorable. What used to be good 450 to 500 bips, or even at some point in time, as high as 5.8%, 580 bips of difference, interest rate differential between the 10-year US Treasury and the 10-year India GSET. We could now that has actually narrowed to as under 2%, right? Now, to my mind, this is a big, big structural positive. We have not seen this kind of environment, at least in my last 2.5 decades of experience, we feel that this can actually have a very important role to play for foreign investments in the country. Not only that, I think it also is a sign of uh, a very, very strong currency, right? So if you will see from the next slide over here, uh, the currency has been extremely, extremely stable, right? If you see the Indian currency, if you go back to the era of before 2014, Indian rupee used to depreciate by almost 5 to 6% annually. That has actually come down under 3% over the last 5 to 7 years now, a little more than 7 years. In fact, if you see the last 2 years, the calendar year 23 and calendar year 24, we have depreciated much below 3%, right? And even if you see relative to the other currencies, Indian rupee has been very, very resilient in a very volatile environment that we have seen in the last I would say, few quarters, right? So I think this is something what has been very, very positive and which also is reflected if you see in the flows. If you see the FIIs, which was negative for the first 9 months, or from January, or sorry, from October 24 to March 25, those 6, 7 months when the markets were down, they have already turned positive for the last 2 months. But even more important, if you see the DII number, that looks so solid. They are up, we've invested more than 8 lakh crores in the last almost 17 months. So I think this is something which is structurally very, very positive. Their DII is becoming so large that in spite of FII selling out more than 2 lakh crores, it was very easily absorbed by the Indian equity markets, right? So I think structurally, I think the global macros are all in favor. Even on the domestic side, we are seeing quite a few positive things. So I think one of the most important things in my last 2.5 decades, we have always seen oil prices create a great havoc always for Indian economy, because we are a large importer of the oil, right? And if you see the oil prices, they have just been going down, down, and down, and they have continued to remain now significantly below the $80. Generally, we all know that $80 is a good thumb rule where we say as long as it's $80, the Indian economy can absorb it. The Indian economy GDP growth doesn't get impacted too much because of the oil prices. But now that we have this, we are good 20% below the $80. So at $65 or so plus minus, I think it's a very, very big positive from the Indian economy perspective. The next, if you see, the other very important thing is in terms of the food inflation, right? This is something what has been very structurally again coming down over the last 2 quarters now. And of course, that also is now clearly getting reflected. If you see even today's RBI policy, I think a 50 pips cut was much, much higher than anybody expected. Of course, the expectations of monsoons is also very, very strong. I mean, this is the third or the fourth year of normal monsoons, and this also gives a lot of confidence to RBI that the inflation will remain under control, and therefore we have already seen 100 pips lowering of the interest rates in the last 6 months itself, or in the last 1 year itself. We can see that, which is I think going to have a significant amount of positive multiplier in terms of our overall growth, right? So this is something what we believe on the domestic side. I think if you see also in the next slide, the RBI dividend, right, has been growing over the last so many years, and the recent dividend of almost 2.7 lakh crores is once again a record number. And this really also helps the government to invest in infrastructure assets. And because of this RBI actions in terms of the interest rate cuts, in terms of the CRR leeway that they have given, in terms of this RBI dividend to the government of India, I think all of that is clearly helping the liquidity to be very strong in the in the entire ecosystem. So you can clearly see from here what was a seriously a negative kind of liquidity just about maybe 5, 6, 7 months back. Now we are actually going into a very big positive durable liquidity. So I think this is something which is really going to help in terms of the discretionary consumption coming back, which has seen some slowdown in the last couple of quarters. But I think the actions from both the RBI, actions from the government of India in terms of the taxation relief that they've given in the budget, a lot of these macros in terms of low inflation, and of course very stable currency. I think all of this is really going to help, overall. Of course, the last thing that I want to talk on the macros is on the tariff side. So whether whatever it may be, I think one thing is very clear that India is definitely relatively in a much better position compared to all the other countries, at least all the other competing countries to India for the products that we sell to USA. So clearly, we are in a much better position. And more importantly, I think the worst is behind as far as the tariff headlines is concerned. Clearly, US as a US government seems to be on a back foot. A lot of things have already backfired to them, and from that perspective, I think the worst is over. And we believe that things are going to be probably much better than the announcements by the US government. And in any case, as compared to the other competing countries, Indian corporates will have an advantage in terms of relatively lower tariffs. Now coming to our MK Capital Builder product, uh, like I just showcased earlier, that we clearly have outperformed very strongly over the returns. And one of the reasons is that over this 12 years, we've delivered nearly 17% compounded returns. One of the key reasons for that is that we have been focused on highly secular sectors. And as you can see on the screen, some of these sectors, whether it is private sector banking, autos, discretionary consumption, healthcare, IT, these are few sectors which have always been secular in terms of the returns over a longer period of time. So you can see the last 1 year returns, you can see the last 12-year returns, and that is where the positioning of the portfolio has been very strong. The other very important thing that I want to highlight here, if you see the earnings growth of our portfolio has been very strong. If you see the FY25 full year, the portfolio earnings growth has been upwards of 18.5%. Let me tell you this, the Nifty earnings growth has just been under 3 to 4%. Our portfolio has delivered 18% portfolio growth for FY25. This has been one very big positive, to my mind, and this is where our bottoms up. This is where our research, this is where our conviction all comes into play. And we have a very strong history of having compounders in our portfolio. So a lot of businesses that you're seeing here, good 60-70% of this portfolio stocks, we've been owning it for the good last 5 to 7 years. In fact, some of those stocks we've been owning it for the last 10 years also. If you see, the positioning of our portfolio over here, these are some of the key sectors where we've invested, whether it is auto and auto ancillaries, consumer services, private banks, IT, pharmaceuticals. These are few sectors where we are significantly overweight. If we look ahead for the current financial year, which is FY26, we are expecting a 35% earnings growth. We have a few businesses like Zomato, of course, the new name is Eternal, and of delivery, which are clearly good turnaround cases, both from the food delivery business and also your quick commerce, and on the logistics side. These are three businesses, and these companies we believe have really earned the right to win. They are clearly disruptors, and that is where our a big earnings driver is also coming from. But even X of that, we are expecting a good 23% earning growth for FY26. And the ROE of our portfolio is also fairly strong at almost 16.5, 17%. So the USP of our MK Capital Builder portfolio is investing in businesses which are high quality, investing in businesses which have a very decent growth and which are not only decent growth for next 1 or 2 years, but which are secular growth stories, and buying at reasonable valuations. So you can see even the peg of our portfolio is just about 2 on FY26. If you take it to FY27, which is on a 2 year forward basis, the growth is looking even better. So if you see the next slide over here, clearly the earnings growth that we expect over the next 2 years is actually upwards of 30%, right? And that is what we are clearly focusing on, buying businesses which are very, very high quality in terms of their management quality, in terms of their business quality. When I talk about business quality, each of these businesses have very, very reasonable amount of, in fact, most of our businesses are debt free. Lot of our businesses where they have debt also, but they would be under too much of control. And each of these businesses generate tremendous amount of cash flows. So this is something what we are extremely, extremely focused about. And of course focusing big time on the growth. So our portfolio is very much positioned to invest where we see growth, but of course buying them at very, very reasonable valuations. So this is something what I just thought we will share with you today. If you just see overall, and all of this of course delivers into great performance over a longer period of time. Uh, if you see the last 1 year, 2 year, 3 year, 5 years, we have been outperforming both the BSE 500 and the Nifty 50 TRIs. In fact, if you see the 3 year and the 5 year, we've had a outperformance of as good as 300 to 500 bips over the benchmark, and this is on a compounded basis. So I think our USP continues to be doing long term investing in high quality businesses at very reasonable valuations, and making sure that we do not compromise on any management quality at all. So I just thought I'll share this so much, and we'll be very happy to make this a very interactive session. Uh, please feel free to ask any of your questions.
So I have one question. It says that PE at portfolio level is upwards of 54. Does this justify to have these stocks?
No, so the whole point is that when you look at the P, that is a trailing P, right? When you look at the forward P, so Sakshi, can you share that slide of FY26-27 and we can see the forward P? Because finally, what is relevant is only future. So if you see the forward Ps, they are not so high. Yes, so you can see the forward P of the portfolio is at under 24 times. On March 27, it is just about 24 times. The earnings growth also that we are expecting over this next 2 years is of upwards of 24% compounded. This is on a model portfolio. So clearly, the P is not as high as one you think, because once you have businesses with high growth, there will be some premium as far as the P multiples is concerned. But as soon as that growth comes in, it does get factored in, and that is why it is important to invest in businesses which are high growth businesses, and also buying them at reasonable valuations. So I think looking at the historical piece will sometimes make you miss good opportunities, because as they say, when you are while you are driving, the rear view mirror is just for reference. It is more important is your front, and you need to really look into the front, because what is relevant is only future. So I think it is important that you one has to understand where are this business headed, not only in fact I would say next 1 2 years, but over the next 3 to 5 years. Directionally, can these businesses become very large? Can these businesses generate tremendous amount of quality cash flows, and the longevity of this, the growth of these businesses? I think that is something what we are extremely focused about, and that's how this portfolio is actually built.
I have another question. It's on Maruti Suzuki. Someone is asking that why is the earnings growth flat for 25-27, and if it's flat, then what is the overall outlook on automobiles?
So, company specific, I would say, as far as Maruti is concerned, it's a function of also their volume growth, right? But there, generally these numbers we are a little conservative, I would say, because the way you have to think about it is what is the current valuation of this stock, and what is the market share? Let's see, for example, if you see in Maruti today, their SUV as a segment, the revenue proportion for them is under 40%. Whereas for the entire passenger vehicles, SUV as a segment is already two-thirds, 65% of the total passenger vehicles sold in this country are now SUVs. For Maruti, it is only 40%. In this year itself, they are going to launch two new models on the SUV side, and I think totally there will be about four models in the next couple of years. As this 40% of the total volumes, SUVs will rise from 40% to maybe 50-55% in the next 2 to 3 years. As that keeps on increasing, you will see a significant amount of jump in terms of their profitability, because the profit per car or per vehicle that they make in SUVs is far more higher than the typical passenger vehicle or the sedans. So as that happens, so when we reach in March 27, the outlook for Maruti for the further next 2 years will be significantly higher, and that's when it will start trading at significant premium.
Another question we have on your look on US recession.
Yeah, so on the US on the US recession, I think it's very difficult to say this, because I will tell you, in the year calendar year 23 and calendar year 24, or at least I would say calendar year 22 second half, and calendar year 23 and first half of calendar year 24, all these periods everybody was almost certain that there is going to be US recession. In fact, all the US corporates have been creating tremendous amount of war chest in terms of increasing their cash balances significantly, or the liquid balances significantly, because in fear of recession and trying to make sure that they survive during those difficult times. But US economy continues to do very well. It's a very, very resilient economy in terms of the consumption side. Of course, today the worry is that because of the tariffs, and because of the dollar depreciation versus a lot of big currencies, there may be a very inflationary environment within US. And can that inflationary environment create some kind of slowdown within the economy, or can there be a recession? My sense is that uh, it's too much to right now believe that it's going to be a hard landing. Yes, there may be some slowdown, but to call it a recession will be a little premature at this point in time.
We have another questions saying that markets are volatile right now. What should be an investment approach? Should they go for an SIP or a lump sum, and for how long?
See, my sense is that at this point in time, actually, I personally believe that lump sum investment is better at this juncture, because markets, we are not in a euphoria kind of a phase. Yes, if we were in the phase of sometime September 24 to December 24, clearly there was some euphoria out there. But I think a lot of that has got completely fizzled out. And as I was just showing you in some of the slides earlier, that the macros, both the global and the domestic, are now actually turning in favor of a higher GDP growth. And of course, that will also lead to higher corporate earnings growth. Once that happens, my sense is that markets will do much better than what most of the people are fearing at this point in time. So my personal bet is that this is probably a time to actually go lump sum rather than timing the markets by through SIP.
Interesting. Someone is asking that since we had recent terror attacks and we saw an uptick in the defense sector, what are your views going forward for that sector?
No, clearly, defense will have tremendous amount of traction. Defense companies are going to, for the next 3 to 5 years, their order books are going to be absolutely full because I think it's not only now a routine thing, it's become a very emergency or a need of the hour because we will have to remain on our toes for at least next few years because the way the events have evolved. So yes, definitely, our defense companies, businesses will definitely have a lot of traction. They will have a lot of business coming in. The only question out there is in terms of the valuations. So I think that is something what one will have to be a little bit more selective over there, much more bottoms up, rather than generalizing the whole space. As far as investing is concerned, as far as those businesses are concerned, my sense is they will do quite well.
We have another question specifically on gold and silver. They are touching new highs, but given we are in a rate cut scenario, what are your views for that?
Uh, See, although we are equity guys, but just as a personal view, my sense is the rally that you are seeing in the precious metals is more to do with the US dollar rather than anything to do with the domestic factors. So the domestic rate cut cycle has nothing to do with the to do with the precious metal prices that we are doing. Clearly, the precious metal prices right now are driven by the global factors. And again, the same story out here in terms of the de-dollarization. Like as I mentioned earlier, dollar has been depreciating. It has not. It has been depreciating against euro. It has been depreciating against UK pound. It is also depreciating in a way against the precious metals. So like I think in December 22, gold prices were in the range of $2,000 an ounce plus minus, anywhere between 1900 to 2200. Today it's about 3300. So this good 50-60% rally is, to my mind, a function of de-dollarization, money moving out of dollar assets and getting into all kinds of other asset classes, whether it's a different currency, whether it is emerging markets like India, or whether it is other commodities and precious metals.
Someone is asking that Q4 results showed large caps didn't do well compared to mid and small. Will this continue or will large caps bounce back?
See, I wouldn't say that large cap didn't do well. It's just that the relatively mid caps results were a little better. But we have to understand that when you look at this quarterly results, they are a catch up kind of thing. So maybe large cap did much better in the first half or even in the Q3, and maybe the Q4 again mid cap started doing better. So I think the way you should look at it is where is the earnings growth headed over the next 2 to 3 years, right? And as I was showing you earlier, because kind of the steps that both the RBI and the government has taken, they are trying to release a lot of liquidity into the system, which will actually kind of unchoke the entire system, which is where the discretionary consumption will come back, which is where the capital expenditure, because the government of India has also been doing significant amount of capital expenditure in the last 2 3 months now, and they have a budget for that, which is a very decent number of good 11 lakh crores, which will continue to happen. But even private sector capital expenditure is expected to pick up quite significantly over the next 6 to 9 months, particularly for the export side. So I would say that both large caps and the mid and small, you will see decent earnings growth over the next 2 to 3 years because the overall growth in the economy is going to come back quite significantly.
We have another question on sector outlook. What are your small term bets and long term bets?
So, clearly on the sectors, we showcase that slide, and I will just request Sakshi to share that slide on the sectors. So, on the secular trends, we have seen that sectors like private sector banking, healthcare, pharmaceuticals, auto, IT, these are some of the very clear secular growth trends, which is where we have been betting also. If you see our portfolio positioning very clearly, these are 4 or 5 sectors where we have very, very good allocation. And in fact, as high as 75 to 80%. And this is where we believe the secular growth will continue. Because again, if you think about it in each of the sectors, like say, for example, in the pharmaceutical sector or the healthcare and the pharmaceutical sector. So our bet over there has been in sectors like contract research and manufacturing in the CDMO space, and we believe that that's a very, very there's a significant amount of tailwind in that business. The China plus one story out there is real. Indian companies have demonstrated that they have the right to win because they have the domain expertise as far as the chemistry skills is concerned, as far as the scale that they can actually deliver, and their respect for intellectual property rights. So I think that is how we have positioned ourselves. If you think about from the auto perspective, like we have invested in businesses like Eicher Motors and Maruti. So both these businesses we believe is there is a story of premiumization, right? So today we sell a little more than 2 crore two-wheelers in this country, but majority of them are in the range of maybe 100 to 150 cc. Whereas Eicher Motors, a flagship product, Royal Enfield 350 cc, today they sell a little less than 1 million bikes, less than 10 lakhs. So out of this 2 crore, only 5% of the market is with them, which is the premium bikes. Our sense is this market will just keep on growing and growing over the next maybe 3, 5, 7, 10 years, right? What is 5% today can become maybe 10, 15, 20% of the overall market. So that's a tremendous amount of growth for them. Similarly, for Maruti, as I was mentioning earlier, again a premiumization story. 40% of the business, 40% of the total volumes is only the SUV today, whereas the market has moved to as high as 65%. So as Maruti keeps on launching newer, more models on the SUV side, their share of the total revenue will come more from the SUVs, and that's where again the premiumization story will play out. So that is how we think about it. Or say, for example, private sector banking. Private sector banking over the last 20 years has been gaining significant amount of market share from the public sector. We believe that will accelerate even more with the kind of the reach that they now have, both on the physical and the digital side. The kind of the investments that they have done on the digital side are absolutely unparalleled, at least by some of the leaders within the private sector banking. Kind of the large franchisee with the consumers that they have built, particularly for the deposit side. I think that's again a very, very big edge that the private sector banking leaders have created for themselves. So I think this is again a large or a very, very long secular trend as far as the private sector banking is concerned. I think IT also today there is significant amount of I would say apprehensions towards the IT as a sector. We believe that the kind of the work that a lot of global large companies have to still do to migrate a lot of their data from their mainframes to the cloud infrastructure is still pending. Not only that, I think when we all talk about AI is also real today, but to make the mainframe data compatible with the AI, again, a lot of work needs to be done, which is again reflected in the kind of the large order wins, in fact, record order wins that IT companies have had in the last 2 years. The execution of that will start, I would say, in the next few quarters, if not earlier. So again, these are secular trends that we are observing, which is where our bets are.
We have next question. Someone is asking, why don't you have any NBFC or AMC business in your portfolio? Any specific
Right.
reason?
Right. So I would say that. NBFCs again, private sector banking. We believe that the businesses that we own have very strong franchises on a longer duration. But there are a couple of good quality NBFCs also, be it Bajaj Finance, Chola Investment. So probably at an opportune time we will look into it. Even AMCs we believe is a high quality business. Definitely it's on our radar. At some point in time, we would like to invest in them too.
Let me check for more questions. View on China's control on rare earth metals and impact on our economy.
Yeah, so I think this is the hot topic for the last 1 week, and I'm sure there will be solutions to this. Like we've had some challenges in the past, like we had some serious challenges with semiconductors. Just about I think around the COVID time, eventually it all got sorted. I'm not overly worried in terms of this. Short-term glitches that we always keep on coming up. Each of these business entrepreneurs are very smart. They understand how to fix these things up. It may take some time at times, but overall, I'm not overly worried. Plus, I think these are materials mainly for EVs. EV itself is still not very large in the overall volumes. It is still building up. So I think by the time EVs become a significant portion of our total volume, there will be definitely some permanent solutions to this.
We have question on pharma sector. We are asking the outlook if Trump, there are more tariffs coming forward on this.
Right. So again, we have to understand, this is what we have been saying for a while, that this tariffs is one thing, but it's finally at the end of the day, it's a highly competitive market, particularly in the global scenario, right? So if today Indian companies have a very large market share in the US as far as their medicines is concerned, it's because they have a great value proposition, right? And this value proposition is what? That we deliver to you quality medicines, we deliver to you on very timely basis, and we deliver it to you on the most cost effective. Now, if somebody has been following this for a while, for the last few years, since 2016-17, already the suppliers for the medicines to the US markets have had some I would say serious amount of price corrections, and that's because the customers over there have already got consolidated. It's just 3 or 4 players in the US market who command more than 95% of the entire purchases from the global suppliers of medicines. So they have been squeezing all these suppliers for the last 6, 7, 8 years. Effectively, what has happened is that the returns that the medicine suppliers from countries like India are not making any, I would say, super extra returns. They are just making returns in the. I mean, when I say return, when I'm talking about the return on capital employed or return on equity, they all have just come to very normalized kind of returns in the range of 10, 12, 15%. Effectively, what I'm trying to say is that there is not much of room for these medicine suppliers or pharma companies to absorb any tariff hikes. Effectively, if there are tariffs, they will be passed on to the US consumers. And this is what I was telling you earlier, that this is where there is a risk of US economy becoming highly inflationary, and that may actually disrupt their entire consumption or slow down their consumption. So that is the risk that we run. But I am not overly worried that the tariffs will have an impact on pharma companies out in India who are suppliers, because there's hardly any super normal margins with them left with them to actually absorb.
I think this brings us to the end of our Q&A session. Sachin sir, thank you so much for being a part of this webinar and for your sharp and thoughtful insights as always. It's been a pleasure to hear your views on the market and Capital Builder. To everyone who joined us today, thank you for your time and engagement, especially on a Friday evening. If you have any more questions or would like to discuss anything in more detail, please feel free to reach out to us. We hope you found today's session insightful and look forward to connecting with you again in the next edition of MK Edge. Have a great evening ahead.
Sakshi, I think there's one question that's come up from Job Peter John. If you can have a look.
Okay, we are seeing all promoters and PE funds are selling huge, as Peter Lynn said. A promoter has 1,000 reasons to sell his stock, but only one reason to buy is that he knows the business is going to do well. What's your view on that?
I think it's a very important and a very pertinent question because we've seen good amount of 70,000, 80,000 crores of selling just in the last maybe 45, 50 days. Clearly, but this also shows that we have tremendous amount of liquidity which is able to absorb this. There's tremendous amount of appetite for equities as an asset class. That's the paradigm shift that we are actually seeing with the Indian retail investors. Now, coming to how should we signal this? I think it's a very company specific view that we will have to take. Businesses where we believe that there is a decent amount of growth outlook, businesses where we believe that there is longevity of this growth, businesses where we believe that the growth is high quality growth. I think this over a period of time, this may all look a little small because the businesses itself will become very large. Secondly, I think today we have to also understand that promoters of some of these companies are evolving. If you go back maybe 2 decades or 3 decades back or even a decade back, a typical promoter would just keep on doing their own business and they are not really looking outside of their business. But today, the next generation is always looking to try something new, and from that perspective, sometimes there are requirements in terms of the funds, and if they have to sell a little bit of their a small stake from their existing business to to do some adventure in some different kinds of businesses as an investment. I think one should look at it with a much more open mind rather than thinking that they have a negative view on their own businesses.
I think that's it. That's the end of the Q&A session.
Thank you so much. Have a great evening, everyone. Thanks, sir.
Thank you so much.